All right, America. Quick question. Have you looked at your paycheck lately and thought, why does it feel like I'm working more, but keeping less? Because 2026 might be about to make that feeling official. The IRS has quietly rolled out new tax brackets, bigger standard deductions, and inflation adjustments for the 2026 tax year. And on paper, it looks like a win, straight from the Internal Revenue Service. But here's the twist. According to coverage from AP News, inflation adjustments don't always protect the middle class the way people think, especially when wages lag behind prices, pushing families into higher effective taxes without ever moving up a bracket. And when NerdWallet ran the numbers, they found that for many middle-income households, those higher deductions may barely move the needle, while everyday costs keep climbing and tax credits phase out faster than expected. Now this is where it really gets uncomfortable. The Institute on Taxation and Economic Policy says that under current law, 2026 delivers the biggest long-term benefits to high earners, while middle-class families see little relief, and in some cases, higher overall tax pressure. Even the Tax Foundation points out that changes tied to investments, capital gains, and estates tend to favor wealth, not wages, meaning if you rely on a paycheck, not a portfolio, these changes could hit closer to home. So while the headlines talk about inflation adjustments and tax relief, the real story is hiding in the fine print. Who actually wins under the IRS 2026 tax changes? And why does the middle class once again feel caught in the middle? Let's break it down, clearly, honestly, and without the IRS jargon, so you know exactly what 2026 could mean for your money. All right, let's get into what's actually changing in 2026, because this is where most people get misled. The IRS has officially confirmed that federal tax brackets for 2026 are being adjusted for inflation. And according to the Internal Revenue Service, every bracket from 10% to 37% is shifting upward to reflect higher prices. Now that sounds like relief. But here's the catch. As reported by AP News, inflation adjustments don't lower your tax rate. They only try to stop inflation from pushing you into a higher bracket. So if your paycheck didn't grow faster than inflation, you're not really ahead. You're just trying not to fall behind. And most Americans already feel that. According to NerdWallet, the standard deduction is also going up again in 2026, which means less of your income is taxable. But those increases are mostly designed to keep pace with inflation, not to increase buying power or create real savings for middle-income households. Here's where it starts to sting. While brackets and deductions move up quietly, many tax credits either phase out faster or don't rise at the same pace. And the Tax Foundation explains that this is exactly why middle-class taxpayers often feel squeezed even in years labeled as inflation-adjusted. You might not owe more on paper, but you may keep less in reality. And when analysts at the Institute on Taxation and Economic Policy looked at the full picture for 2026, they found something even more uncomfortable. Under current tax rules, the biggest long-term benefits continue flowing to higher-income households, while middle-income families see minimal relief once everything is added up. That's the quiet part no one puts in the headline. Because if your income comes from wages, not investments, if you rely on a paycheck, not a portfolio, these IRS changes don't hit you the same way. So before anyone celebrates tax relief in 2026, the real question becomes, are these changes actually helping the middle class, or are they just preventing things from getting worse? Now let's take this one level deeper, because this is where the middle class really starts to feel the pressure. On paper, the IRS says inflation adjustments are meant to protect taxpayers, and according to the Internal Revenue Service, tax brackets and deductions for 2026 are rising to reflect higher costs. But here's the problem most families are already living through. As AP News has repeatedly pointed out, inflation doesn't hit everyone evenly. Prices for housing, groceries, insurance, healthcare, and transportation rise faster than overall inflation, and those are exactly the expenses middle-class families can't avoid. So while the IRS adjusts tax brackets upward, your real spending power still shrinks. And when NerdWallet analyzed the 2026 changes, they found that many middle-income earners may technically owe a similar tax percentage as before, but take home less disposable income once rising costs and shrinking credits are factored in. This is where the system quietly tightens. Tax credits, like child-related credits or earned income benefits, don't always rise at the same pace as inflation, and the Tax Foundation explains that these credits often phase out right in the middle income range. That means you can earn just a little more and suddenly lose thousands in benefits. Not because you're rich, but because you crossed an invisible line. And according to research from the Institute on Taxation and Economic Policy, this is exactly why the middle class often feels squeezed the hardest. They earn too much to qualify for full credits, but not enough to benefit from investment-based tax advantages. Meanwhile, households with higher incomes don't rely on wages alone. As the Tax Foundation notes, tax rules tied to capital gains, retirement accounts, and estates are structured in ways that reward assets, not paychecks. So if your income comes from stocks, property, or long-term investments, inflation adjustments work differently for you. But if your income comes from a job, clocking in, working overtime, and hoping your raise beats inflation, these IRS changes don't offer the same protection. And this is why AP News describes the 2026 tax year as one where Americans may feel a growing disconnect between what tax policy promises and what household budgets actually experience. You're told taxes are adjusted. You're told relief is built in. Yet every month still feels tighter. That's not an accident. It's how the system currently functions. Which brings us to the most important question. If the IRS is adjusting everything for inflation and middle-class families are still falling behind, then who is this system really working for? Now, let's talk about the part most headlines skip. Who actually benefits from the IRS 2026 tax changes? Because once you zoom out and look at the full picture, the winners become very clear. According to analysis cited by the Institute on Taxation and Economic Policy, the largest long-term tax benefits under current law continue flowing toward higher income households, especially those earning money through investments rather than wages. And that matters more than people realize. As the Tax Foundation explains, income from capital gains, dividends, and long-term investments is often taxed more favorably than regular paychecks. So when inflation adjustments kick in, those with assets feel protected, sometimes even advantaged. But if you're middle class, most of your income doesn't come from investments. It comes from work. And AP News points out that wage growth has lagged behind inflation for many American workers, meaning even when tax brackets move up, real financial pressure stays right where it is. This is why two people can live in the same economy, under the same tax system, and feel completely different outcomes.